John Young. I'm a co-founder and co-CEO at Canal Group. We're a private credit manager in the U.S. based in Miami. You can see the backdrop. But we were in New York. Our last company, we had a company called C-Band Partners that we built up to about 15 billion of AUM, and we sold it to Carlyle back in 22. And then, as you recall, in 2022, everything went bad, and the risk-free rate went from 0 to 5, and loans we were making at 4.5% were now 12%. So it became like a incredibly interesting opportunity set. So we decided to do it again. The regulatory environment has gotten a little bit better for the banks, but not much better. The government was going to clamp down on their risk capital ratios, and I think they pushed that out a little, so they feel a little bit less paranoid about using their balance sheet. So I would say the competitive environment is still pretty good, and there's a lot of good companies. I would say the one thing that's happened in the last year or so has been that the M&A volume has slowed down. And part of that was driven by, all of the tariff announcements and all of the volatility that came around back in April. And it's really, amazing when you think about it that, 4 months ago, the VIX was at multi-year highs. People were jumping out of windows and, thinking the economy was going to go in the toilet. And now we're right back to all-time highs on stocks. Crypto is through the roof. People are launching SPACs again. It's a fascinating reversal in a very short period of time. But despite that, there hasn't been as much M&A as we had expected. So M&A is kind of what drives our lending business, because it's basically when, let's say, Apollo or Blackstone wants to buy a company and they're going to pay $1 billion for it, but they want to borrow 400 and write a check for 600. We'll be part of the group that lends them the 400 million to help them buy the company, and we generally charge about 10% interest for that. And like I said, that's historically really high interest rate for being first lien risk against a pretty big company with a lot of equity below you. Like I said, for most of my career, that was mid-single digits or lower interest rates. Now it's double digits. So that's been that the volume of those deals is usually driven by private equity firms buying companies from each other or from spin-outs from public companies. But it's been slow just because I think the volatility in the markets and the higher interest rates have dampened private equity appetite for buying. I've been doing this for 30 years. I can count 3 years of those 30 where you could get double-digit yields on first lien corporate credit in the U.S. It's a unique time historically in terms of the amount of risk you have to take to get double-digit returns. And also the difference between private credit and all the other alternative assets are that we actually distribute the cash, right? So, if we yield 10, 11%, we send out that 10% quarterly. So we'll send out 2.5 to 3% quarterly to our investors, which, unlike private equity, venture, all of those, you give them your money and you might see some of it back in several years. And that's, I think, the biggest difference in the alternatives world. They call it DPI, and we distribute. That's the nice thing about private credit. And I think if you look at where we expect to be in the next couple of years, I do think, deal flow is starting to pick up as we get the whole tariff tantrum in the rearview mirror, a little bit further in the rearview mirror. So as deal volume picks up, I think you'll have maybe even higher yields. The other interesting thing about this is it's a floating rate. Our loans are floating rate. And, I know Australia, you guys have already cut rates 2 or 3 times, if I'm not mistaken. We haven't really started yet. And, there's an argument to be made that we will, our president is like banging on our central bank to do it. But, we still have inflation here and the job market is softening but costs are going up. It's not a great, recipe for, I wouldn't want to be the head of the central bank right now, put it that way. So it's a, our rates have not gone down, so we generally are floating over SOFR, which is right now 4.30, 4.3%. And, the rates haven't gone down here. So, if we think that we've truly gotten, inflation under control then could we get a rate cut? Sure. But doesn't feel like it. Right? Yeah, it's a very interesting time because, like I said, while you have all of the risk assets are at all-time or near all-time highs or tights if you're a credit investor, um, the underlying economy doesn't feel like that, which is interesting, right? I think you're starting to see the low-end consumer really showing some cracks. You have, car loan delinquencies at multi-year highs. People are starting to default on credit cards, things that usually are the early sign of, trouble in the economy, but the markets are just ignoring it. And I think a big part of it is earnings have been really good. I think, uh, you know, the S&P 500, I think 84% of companies beat expectations comfortably. You have very good earnings. You still haven't seen the economic slowdown. Everybody said, okay, post tariffs, we're going to have inflation and the economy is going to go into recession. We've had neither. So it's been, I think people are taking a lot of comfort in the amount of spend that's occurring around AI, data centers, and power, which is, again, if you look back in my career, I've never seen this amount of capital being mobilized for one very specific strategy. And, we'll see. I think it's going to create incredible opportunities to both create value and also blow yourself up. You have, these hyperscaler companies like Meta and Google and Amazon and that are spending trillions of dollars building out infrastructure for AI. It remains to be seen what the economic profitability of all of that spend is going to be. There's a decent chance that that's going to hit equity investors the hardest. If it turns out that the economic efficiencies that are created by that and the profitability at those companies doesn't, isn't what they expected, I think equity markets are going to take the brunt of that. That's why we like being in the credit markets. We get contractual cash flows. You pay me interest every quarter and I send it to my investors. And, I think, don't get me wrong, I think everybody should be exposed to the Magnificent Seven and all of the, NVIDIA and all of these companies because you're crazy not to but you need to have a portion of your portfolio in something that gives you contractual yield. I think that you'd be also crazy not to have that. And, whether you give it to us or not, that's up to you. But I do think that, it would be wise to be getting 10% contractual, distributions in addition to having bets that could either go up 1,000% or go to zero. There's two sides to it. One is, the whether recession or economic growth. I think if the bull case is no recession, earnings continue to be great like they have been. Tariffs are a non-event like they so far have been. And the economy is growing at a very healthy clip and rates are probably even going higher because you're in an inflationary environment. In that instance, I think you definitely want to be in credit and you probably want to be in some growth equities. The medium scenario is 2 to 4% economic growth, but inflation under control. That's when credit probably outperforms equities the most over a 30-year period, just because you have good yields, not great yields, but the companies are doing extremely well. The bad scenario, but I would say it's bad for everybody, stocks, bonds, loans, private credit, is where you're in recession and the government is cutting rates to try to, prime the economy to get the economy to pick up. So you have lower yields on your credit. You also have higher defaults because the companies are having difficulty. If you think that scenario is coming, I would probably get out of stocks, high growth stocks and credit. I don't personally believe that scenario is in play. I think if anything, what we've seen is central banks and governments will always just print money to get out of any kind of a recessionary environment. It's a shame. I wish it wasn't the case, but it is. And in those cases, hard assets inflation goes higher. Arbitrage fluctuates between private and public credit as the markets go up and down, but where it stands right now is if a private equity company wants to borrow in the private markets, it's probably going to cost them between 125 and 150 basis points more than the public markets. Meaning, if it cost them 10% in the private markets, they could borrow at 8.5% in the public. The problem with that is if they borrow in the public markets, let's say they hire Goldman Sachs to go arrange a $1 billion loan for them, then they're going to have 250 lenders in their deal. They're going to have rating agencies that are going to be asking them a ton of questions and downgrading them if their performance isn't good. You're going to have 200 ESG questionnaires from every mutual fund company and credit manager in the country. You're going to have Japanese banks asking you questions every week about how your performance is. Or you could go to the private markets, have a handful of people, 0 rating agencies, which saves you a lot of money, much simpler doc, and distressed guys can't buy it. So 150 basis, 1.5% higher interest rate to be in the private markets, but you have a much easier existence if you own the company. And so far, I'd say about more than half of the private equity guys I know still prefer to pay up to borrow in the private markets. Whatever the economic outcome is, whether it's the soaring growth, soaring inflation, recession, I think you just want to have the widest net and you want to see the most deals so you can be super selective and have exposure to the best companies. We've got partnerships with banks where, the banks have invested with us in our funds, and they also show us all of their deal flow on the private credit side. Those are extremely valuable because in addition to all the private equity sponsors who show us deals regularly, we also see deals that we wouldn't have seen from some of these bank partnerships. So my job is to cast the widest net so that I can be the most selective and really pick the best companies that will perform in any economic environment. That's the hardest part about our job. The best part is our credit is still a cottage industry. It is a club, and everyone knows everyone. Everyone knows who are the cowboys. Everyone knows who are the super conservative people. And everyone knows people that have behaved poorly in the past, and you can't hide from your past here. So if you're still in this business after 25 years, you've probably behaved pretty well. You've been but bad people get bounced pretty quickly. I'd say it's certainly below 50% loan to value, meaning the company's worth $2 billion. It should have less than $1 billion of debt on it. That way, if something does, happen to the industry or that company, you have a lot of equity cushion. A lot of private equity has to get vaporized before you lose any money. You want to be in sectors that are that are not prone to major disruption. I would say there have been a lot of sectors in American corporate business world that have been very good for a very long period of time, but that are not very good right now. I would put healthcare in that category. I would put, and software. Software's had a 25-year bull run. And now you've got AI coming in, potentially disrupting companies that have had very predictable cash flows with very little CapEx. So it's an interesting time because I would say a lot of areas that we all considered safe havens for a long time are not as safe anymore. The one thing I do think is worth getting across is I think a lot of people are in older vintage credit funds. And particularly if you go back, 2021 was probably the worst year for investing, no matter what the strategy was. All the private equity funds, all the venture funds, all the credit funds, they're all terrible. And people collectively lost their minds in 2021 coming out of COVID. And so what we're telling people and advisors is if you've got clients that have exposure to 2021 or older vintage credit funds and they can redeem anywhere near NAV, get out. I don't care if you give us the money, but revintage into newer stuff because all of those companies were bought and levered assuming that rates were going to be zero forever. And so they thought that they were going to have interest expense of 5% or less. And so they borrowed a ton of money thinking they were only going to pay 5% interest. Then 2022 happened, that 5% interest went to 12%, and now they can barely cover their interest, much less invest in the company. So those credits, a lot of them are hiding in people's portfolios and they're bad. And there will be a reckoning one day. So what we tell people is if you can revintage into newer companies and newer credits, you really should. And you'll make your clients very happy when the reckoning comes. And at the very least, you'll look smart. But I think it's a key thing to do. If you can revintage out of that older stuff, please do it. And again, you can give it to us. You don't give it to us, but get out of that. The liquid credit markets in the U.S. are trading at multi-year tights right now. So, high yield bonds, investment grade bonds are the tightest, lowest yields they've been in years. So you're getting in at the absolute worst time, probably, if you want to get into the U.S. liquid credit markets in recent memory. The private credit markets are at not the wides, but very, very far from the tights, double the tights. The other thing I would say is, you have to understand that liquid credit markets are great in that you can get liquidity, but when they are much more volatile. So the private credit markets are much less volatile there. So if you go back to look at COVID back in 2020, the liquid credit markets were down 20 to 30 points, depending on which one you're looking at, 20 to 30% in a 2-month period. The private credit was down 4 to 5%, which, in a time where people are really feeling bad about their portfolios, and it's nice to be the best performing asset class and the least volatile. And that's why we think it has a place in everyone's portfolio. Number one, like I said earlier, it distributes cash every quarter, and it's very low volatility and not correlated to the rest of the markets.